Welcome back, my friends. As you may have noticed, we are seeing many experts making many assessments and predictions about the economy. Speculative investments are having a disastrous year. Cryptocurrency companies are going bankrupt. FTX declared bankruptcy just this past Friday. Risk assets have been losing value at least since January. The benchmark S&P 500 is down almost 20% this year. Many stocks, tech and real estate related stocks, are down anywhere from 30% to 97%. A wave of layoffs is sweeping the United States. The layoffs are more concentrated in technology companies, but retail and shipping are not immune. Many real estate YouTubers are saying all sorts of things about the housing market. House prices are definitely going down. And overall real estate sales are declining each month. As we all know, inflation continues to rage in many countries. And the Federal Reserve is aggressively raising interest rates. That is raising the cost of borrowing. And many big purchases rely on borrowing. So, business for house and car purchases is in decline. There seems to be some debate about what is really going on. And today, we are getting news that manufacturing in China is collapsing. Manufacturing orders for China from the United States are down 40%. One U.S. logistics manager has referred to the situation as an unrelenting demand collapse. Because of the sudden and dramatic slowdown, Chinese factories are shutting for an extra 2 weeks during the holiday season. Is this just a correction or is it a collapse? Or is it a slow-motion train wreck in which prices keep slowly trending downward for a long time? What does this mean for the future of the economy? And what does it mean for the future of the United States? But before we get into that, please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. It is a very bad time for the shipping industry, said Asia-based shipping firm HLS. The volume of shipping containers from China to the US fell 21% in the past 3 months alone. Sailings of container ships are being canceled. And ocean carriers are experiencing export rollovers. Logistics managers in the US are preparing for delays in the delivery of goods from China. Carriers have been announcing more blank sailings and suspending services. They are trying to balance supply with demand by executing on an active capacity management strategy. The unrelenting decline in container freight rates from Asia, caused by a collapse in demand, is compelling ocean carriers to blank more sailings than ever before as vessel utilization hits new lows, said Joe Monahan, CEO of Worldwide Logistics Group. Orders in China from the United States are down a whopping 40%. Many of the manufacturers will be closed in early January for the holiday, which is much earlier than last year, Monahan said. Supply chain research firm Project 44 tells CNBC that, after reaching record-breaking levels of trade during the pandemic lockdowns, shipping volume from China to the US has significantly pulled back since the end of the summer, said research firm Project 44. It seems to be a very bad time for the shipping industry. We have the combination of declining demands and overcapacity as new tonnage enters the market, said Asia-based global shipping firm HLS. HLS analysts are expecting shipping container volumes to decline another 2.5%. And that collides with a planned 5 to 6% increase in shipping capacity in 2023. So that means that freight rates will likely head lower in 2023. The container shipping market will be further complicated by economic uncertainty, geopolitical concerns, and also the increasingly heated market competition, HLS wrote. There are some early signs of an inventory correction, said OLUSA CEO Alan Baer. Asian ocean-borne carriers are canceling more vessels. Space has already tightened, so while demand is soft, space may be at a premium in January and throughout Q1, said Baer. But, on the positive side, inventory depletion and the need to restart the order and delivery cycle appears to be inching upward, Baer also said. Ports on the west coast of the United States appear to be taking the biggest hit. U.S. imports from Asia plunged in October to their lowest level in 20 months, said HLS. The spot rate for a container from Asia to the U.S. West Coast has crossed the break-even point, with little room for further reductions, HLS wrote. The large West Coast ports of Los Angeles and Long Beach have experienced the largest drop in trade, said Project 44. The risk of a major union strike at West Coast ports has rerouted some shipments to the East Coast. Back in June, J.P. Morgan CEO Jamie Dimon warned about a coming economic hurricane. But it may be less intense than Dimon originally feared, according to a new report from J.P. Morgan Chase. We see the U.S. in a mild recession in the second half 2023, said J.P. Morgan economists Michael Feroli and Daniel Silver. The Federal Reserve has been aggressively raising interest rates to tame inflation. And it is expected to complete its rate-raising mission to conquer inflation. We're effectively looking for a Category 1 economic hurricane, the Feroli and Silver wrote. What are the risks? Weakness could build on itself, requiring a larger response by the Fed to get the economy back on track, Feroli and Silver added. The note from Feroli and Silver comes following a better-than-expected Consumer Price Index, CPI, report. The CPI report said there are signs of prices are beginning to moderate. And persistently high inflation seems to be moderating. The report by Feroli and Silver seemed to cause a rally on Wall Street. Investors somehow expected that positive inflation news would cause the Federal Reserve to rethink its course. But Federal Reserve leaders doubled down on their position that more interest rate hikes would be needed. Feroli and Silver are predicting that the Federal Reserve will continuing to tighten monetary supply. And that the tightening will continue well into 2023 before pausing. Feroli and Silver say that they expect that Federal Reserve will raise the federal funds rate by another 100 basis points overall. They are predicting a 50 basis point increase in December. And they are also predicting 2 additional 25 basis point increases in February and March. That would result in a federal funds rate near 5% by May. Many economists think that amount of financial tightening would push the U.S. economy into recession. But at the same time, the U.S. economy has stayed somewhat resilient. Job growth has stayed fairly durable despite the fast rising interest rates. And consumers continue to spend money. But consumers are now focusing on needs versus discretionary items. Feroli and Silver expect the tight job market to deteriorate heading into the end of the year. Keep in mind that even in a mild recession scenario would weaken the job market. And, in that case, the U.S. would shed over 1 million jobs by the middle of 2024. There are already signs that firms' appetite to hire is easing, and we expect that to continue next year to the point where we see outright declines in the monthly job figures in 2H23, Feroli and Silver said. Markets are now rewarding companies that prioritize cutting costs, and labor costs are often the largest cost category, they added. Federal Reserve Chairman Jerome Powell said that declining job growth is required to bring down inflation. But that is what it takes to recalibrate the economy after several years of pandemic-related disruptions. Whatever the eventual peak in rates might be, Fed officials lately have been stressing that equally important is how long rates remain in that restrictive setting, Feroli and Silver explained. But even taking them at their word, we do think there will be enough evidence of a lasting disinflation that we project easing in 2024, Feroli and Silver added. As far as these economists are concerned, the U.S. economy will enter a recession later next year. And that will cause job losses. Feroli and Silver predict that the Federal Reserve will start to decrease interest rates 50 basis points per quarter starting in 2Q24. And that the federal funds rate will be at 3.5% by the end of 2024. But, Feroli and Silver say that this type of a recession would not necessarily be as destructive as past recessions. Investors and CEOs have been preparing for a recession since the Fed started hiking rates. If we do have a downturn next year, it will be the most well-telegraphed recession in modern memory, Feroli and Silver wrote. That fact alone should change the nature of the slowdown, they added. Some say the painful end of get-rich-quick thinking may be good for the economy. Speculators hoping to make a killing as cryptocurrencies got slammed this year. Cryptocurrency values briefly rebounded from this year's plunge in valuations. But, then one of the most trusted exchanges for crypto trading, FTX, filed for bankruptcy. Old-school financiers look askance at inexperienced crypto investors who they say should have known better. This year, there are new signs of a catastrophic decline in speculative investments in general. And this is part of a general trend that goes far beyond Bitcoin and other cryptocurrencies. A lot of so-called investments, like house prices and tech company valuations, look completely overvalued. That goes for so-called fintech innovations, including cryptocurrency, as well. These risk assets recently seem to be shooting for the moon. But they are now coming back down to earth. Many investors are getting burned as soaring speculative investments crater. Not just that, many people are saying that this trend will actually benefit the economy. Recent years of speculative investments have encouraged get-rich-quick speculation. Rising interest rates mean a return to the old-fashioned kind of investments. Real-world investments that use money and workers more efficiently to create real economic value. Only when the tide goes out do you know who's been swimming naked, said Warren Buffett, a longtime advocate of slow growth. The US is teetering on the brink of recession. But, what do you think? Please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. Please share this video on social media. Thank you for watching.